This chaotic, tangled knot of line charts represents how most people view the market. If you map this structure incorrectly, your trading direction will be wrong, and any advanced strategy you try to apply will fail. Standard price action techniques often leave you guessing in the noise. Smart money concepts solve this by applying strict mechanical rules to identify exactly where the market is going. Look at this upward trend. It's validated when price pushes past a previous peak, a break of structure or BOS. But when price plunges below the recent structural floor, the trend reverses. This is a change of character, or CHoCH. Identifying these patterns on a textbook diagram is easy, but if you attempt to trade this idealized path in the live market, you will blow your account. Real markets are designed to trap traders who act on unconfirmed signals. To avoid those traps, we require strict validation. The first rule is that a swing low is purely hypothetical. It only becomes a valid structural anchor when it actively forces the price to break the previous high. Watch this drawn uptrend. The price dips, tries to rally, but fails to cross the top threshold before dropping sharply. Without breaking the top, that initial dip was never a valid anchor. The resulting drop is an invalid change of character. Treating an unconfirmed dip as a structural floor turns market noise into a false signal. You end up trading a reversal that isn't actually there. The next trap is the micro-pullback. For a dip to be structurally significant, it must retrace a minimum of 40% of the previous push. This chart shows a bullish push, then a minor dip. The Fibonacci tool shows it stopping at 20%, too shallow. To be valid, price must reach the 40% line, capturing enough institutional interest to continue the uptrend. Enforcing a strict 40% depth requirement protects you from entering on artificial, shallow pullbacks. Institutions design these shallow dips specifically to trigger your stop losses. The final rule protects you from liquidity sweeps. A break of structure is only valid if the body of the candlestick closes decisively beyond the line. Look at these shaded candlesticks. A long wick pierces above our structure line, but the thick rectangular body closes below it. This is a trap. Wicks represent temporary institutional manipulation to grab liquidity. Only a firm body close proves a true structural shift in market momentum. Let's put this together. This market chart shows a 30% pullback, followed by a push where only a thin wick crosses the top threshold before the price starts dropping. So if the market price drops below the recent low right now, does it trigger a valid change of character? No. This structure failed on two fronts. The pullback was too shallow, and the break was a wick, not a body close. This complex candlestick chart represents a real market environment. Your job is to hunt for our specific validation criteria amidst the noise. First, measuring the pullback. We can see this dip successfully crosses the 40% threshold. Next, zooming in on the breakout, we confirm a solid, shaded candle body closing distinctly above the line. The momentum is real. With a confirmed break, the anchor line shifts upward to this new valid low. When the price finally crashes forcefully through that floor, we have a valid change of character. By strictly applying these three mechanical rules, the confirmed break, the 40% depth, and the body close, you strip away the chaos. You stop guessing and start tracking the true footprints of institutional money.